Today, we are getting into a tax rule that honestly, every sizable business in India really needs to understand. It's called Section 194Q. So let's just jump right in and demystify this thing. So let me ask you a direct question. Think about your business. Do you buy more than 50 lakh rupees in goods from any one single supplier in a given financial year? Just think about that for a second, because the answer could really change how you operate. Because if you answered yes to that question, well, you might now have a new job. The government has basically made you, the buyer, responsible for deducting tax right from the payments you make to your seller. And this is all because of this rule, Section 194Q. Okay, so what exactly is Section 194Q? Let's get into the nitty-gritty of this new rule for big buyers and, maybe more importantly, why it even exists in the first place. So here's the bottom line. Section 194Q says that if you're a buyer of a certain scale, you have to deduct tax at source, TDS, at a tiny rate of just 0.1%. But, and this is the crucial part, it only kicks in on the amount of your purchases that goes over that 50 lakh rupee mark with any single seller. You might be wondering, why go through all this trouble? Well, the government has a few big goals here. First, they want to widen the tax net to catch more of these high-value transactions. Second, it creates a really clear digital paper trail. And third, it's a clever way to shift the compliance responsibility from, countless sellers to a much smaller group of large buyers. All right, this is probably the most important part for you listening right now. How do you know if this rule even applies to your business? Well, thankfully, it boils down to a pretty simple two-question test. So, question number 1. Take a look at your books from the previous financial year. Was your total business turnover more than 10 crore rupees? If your answer is no, then you can breathe easy. This section doesn't apply to you. But if it's a yes, then you've got to move on to the next question. And question number 2 is about the current year. Are your total purchases from any one single seller then add up to more than 50 lakh rupees? And remember, you have to track this for each individual seller you work with. And there it is. If you're a business that did over 10 crore in turnover last year, and you're buying more than 50 lakhs from a supplier this year, then yeah, you're on the hook. You officially need to start complying with Section 194Q. Now, it's really important to get this right. That 50 lakh threshold isn't about a single big purchase. It's cumulative. It adds up over the year. Let's walk through an example to see exactly how this works. Okay, let's say in June, you buy goods worth 25 lakhs from one of your regular suppliers. Your running total for the year with them is 25 lakhs. So far, so good. You're under the limit, no TDS to worry about yet. A few months later, in September, you place another order for 20 lakhs with that same company. Now your cumulative total is up to 45 lakhs. You're getting closer, but you're still not over the line. No action needed just yet. But then December rolls around. You make another purchase, this time for 15 lakhs. And just like that, your total for the year hits 60 lakh rupees. Bam, you've just crossed that 50 lakh threshold. Now here's the part people get wrong, so listen close. You do not deduct tax on the full 60 lakhs. You only calculate TDS on the amount that's over the 50 lakh limit. So in our example, that's 10 lakh rupees. 0.1% of that is just 1,000 rupees. And remember, every purchase you make from the supplier for the rest of the year will also be subject to TDS. Okay, you really need to pay attention to this because this is a huge trap. That nice low 0.1% rate, that only applies if your seller has given you their PAN number. If for some reason you don't have their PAN, that rate doesn't just go up a little. It skyrockets to 5%. That's a 50-fold increase. It is a massive penalty for what might seem like a small piece of paperwork. Now, here's where things can get a little murky. There's actually a similar rule for sellers called Section 206C1H. So what happens when both you, the buyer, and your seller both meet the criteria for your different tax duties on the very same transaction? Who's supposed to do what? Thankfully, the law is actually very clear on this. There's a pecking order. While the seller has a responsibility to collect tax, your duty as the buyer to deduct tax under 194Q always wins. It takes priority. The buyer's responsibility comes first. If you remember one thing, make it this. It's the golden rule. If a deal falls under both of these sections, the buyer's duty to deduct TDS under Section 194Q always prevails. As soon as you deduct the tax, the seller is off the hook for their part. It's that simple. So, what happens if you just ignore all of this? Let me tell you, this isn't something you want to mess around with. The penalties for noncompliance are really severe, and they can hit your company's bottom line hard. And here's the big one. If you fail to deduct TDS when you were supposed to, the income tax department can say that 30% of that entire purchase is no longer a valid business expense. What does that mean for you? It means your taxable profit shoots up and you end up paying way more income tax. It's a painful penalty that is absolutely designed to make you pay attention. So, how do you make sure you stay compliant? It really just comes down to a simple 4-step process. 1. Deduct the tax at the right time. 2. Get that money deposited with the government. 3. File your quarterly TDS return. And 4. Make sure you give a TDS certificate to your seller so they can get credit for the tax you paid on their behalf. And all of this brings us to one final, really critical question. Sure, you know the rule now, but can your business actually handle it? Trying to manually track cumulative totals for every single vendor is just asking for trouble. So the real question you need to ask yourself is this. Is your accounting software, your ERP system, set up to track this stuff automatically? Because having the right system in place isn't just about making things easier, it's probably your single best defense against making a very, very costly mistake.